You need to understand something right now, before we go any further. What I'm about to tell you isn't speculation. It's not fear-mongering. It's not clickbait designed to scare you into buying gold or cryptocurrencies. This is legislation. This is contract law. This is already written, already signed, already embedded in the legal infrastructure of the global banking system. And if you have money in a bank, any bank, this applies to you. The year 2026 isn't some distant future anymore. We're talking about months, not years. And the changes coming aren't upgrades. They're rewrites. Complete structural rewrites of the relationship between you and your money. But here's the part that should make your stomach drop. Most people have no idea this is happening. They're going about their lives, checking balances on apps, swiping cards, setting up direct deposits, completely unaware that the legal foundation beneath all of it has fundamentally shifted. And that shift didn't happen in some back room. It happened in plain sight. It was announced, it was documented, it was published in financial journals, regulatory updates, and central bank white papers. But nobody reads those. Nobody watches the fine print when it's dressed up in bureaucratic language and spread across hundreds of pages of legal jargon. That's by design. Because if people actually understood what was written, there would be riots. There would be bank runs, there would be mass withdrawals that would collapse the system overnight. So instead, it's been normalized. Gradually, quietly, wrapped in terms like financial stability, systemic risk management, and depositor protection frameworks. And that last one, depositor protection, is the cruelest irony of all. Because what's coming in 2026 isn't protection. It's the exact opposite. It's the legal authorization for banks to do something they've never been allowed to do before, at least not openly, not without consequences. They're about to gain the right to take your deposits and use them as their own capital during a crisis. Not lend them, not invest them with your implied consent. Actually absorb them, convert them, make them part of the bank's balance sheet to prevent collapse. This is called a bail-in, and if you haven't heard that term before, you need to remember it now, because it's the single most important financial concept of the next decade. A bail-in is the opposite of a bailout. In a bailout, the government steps in with taxpayer money to save a failing bank. In a bail-in, the bank saves itself by converting the money of its depositors and creditors into equity. Your cash becomes stock. Your savings become shares in a failing institution, and you don't get a choice. You don't get a vote. You don't even get a phone call. It just happens. One day you log in and your balance is gone, replaced with equity in a bank that's currently underwater. And here's the kicker. This is legal. It's not theft under the law, it's restructuring. It's been codified into international financial regulations, starting with the Financial Stability Board's guidelines in the aftermath of 2008, and then embedded into national laws across Europe, North America, Australia, and beyond. In the United States, it's buried in the Dodd-Frank Act under Title II. In Europe, it's the Bank Recovery and Resolution Directive, also known as BRRD. In the UK, it's the Banking Act of 2009, updated multiple times since. And in each case, the language is carefully constructed to sound reasonable, to sound like a measured response to financial instability. But what it really does is this. It takes the risk of banking failure and transfers it from the institutions and the government onto you, the depositor, the person who thought their money was safe because it's insured. But insurance has limits. In the U.S., the FDIC insures up to $250 per depositor per bank. That sounds like a lot until you realize two things. First, the FDIC's insurance fund is a fraction of the total deposits it's supposed to cover. As of the last report, the fund held around $128 billion. Total insured deposits in the U.S. over $10 trillion. You do the math. If multiple large banks go under at the same time, that fund evaporates in hours. Second, even that insurance can be delayed, restructured, or converted during a systemic crisis. The FDIC has legal authority to pay out insurance in the form of promissory notes or equity instead of cash if liquidity is insufficient. That means you might get a piece of paper saying you'll be paid back eventually, instead of actual money. But let's go deeper. Let's talk about what happens in practice, because this isn't theoretical anymore. It's already happened. In 2013, Cyprus became the testing ground. The country's banking system was on the verge of collapse. Two of its largest banks were insolvent. The European Union and the International Monetary Fund stepped in, but not with a traditional bailout. Instead, they imposed a bail-in. Depositors with over $100,000 in the Bank of Cyprus lost 5% of their deposits overnight. It wasn't a fee. It wasn't a tax. It was a forced conversion into bank shares that were, at the time, virtually worthless. People woke up one morning and nearly half their money was gone. And it was legal. The government didn't break any laws. They followed the new framework, and the global financial community called it a success. They said it protected taxpayers. They said it stabilized the system, and then they made it the model, the template, the blueprint for every future banking crisis. That was over a decade ago. Since then, the infrastructure for bail-ins has been quietly built into the global financial system. Every major economy now has the legal mechanisms in place. But here's what almost nobody is talking about. 2026 is when those mechanisms go live at full scale. That's the year when new Basel III regulations fully phase in, tightening capital requirements and forcing banks to hold more liquidity. It sounds good on paper. More liquidity, more safety. But here's the problem. Most banks don't have it. They've been operating on fractional reserve lending for so long that their actual liquid capital is a joke. They hold maybe 3% to 10% of total deposits in actual reserves. The rest is loaned out, invested, tied up in derivatives, or leveraged into oblivion. So when these new regulations kick in, banks have two choices. They can raise capital by issuing new stock, which dilutes existing shareholders and makes them look weak. Or they can reclassify existing liabilities, your deposits, as capital. And guess which one is easier? Guess which one doesn't require public disclosure, shareholder approval, or market confidence? The second one. The quiet one. The one that happens on a Friday night when the markets are closed and the press release is written in language so boring that no one reads it until it's too late. And that's the trap. That's the rewrite. Your deposits are no longer considered your property in the traditional sense. Legally, when you deposit money into a bank, you're not storing it. You're loaning it. The bank owes you that amount, but the money itself becomes the bank's asset. That's always been true. But until recently, there were protections. There were assumptions. There was an unspoken social contract that said, yes, technically it's a loan, but we'll treat it like your money. We'll give it back whenever you ask. Not anymore. Now, in a crisis, that loan can be restructured. Your claim on the bank can be converted. And it's not just legal, it's encouraged. It's official policy. The Financial Stability Board has explicitly stated that bail-ins are the preferred method of resolution for systemically important banks. That means the biggest banks, the ones that are too big to fail, are now too big to bail out. Instead, they'll bail in. They'll use your money to save themselves. And you won't be compensated. You'll be a shareholder in a dying institution, watching your wealth evaporate in real time, while the executives walk away with severance packages, and the regulators congratulate themselves for avoiding a taxpayer-funded bailout. This isn't a conspiracy theory. This is monetary policy. And the reason you haven't heard about it is because it's been deliberately obscured. The language is technical. The timelines are staggered. The implementations are fragmented across jurisdictions, so no single headline captures the full picture. But when you step back and look at the whole thing, it's unmistakable. The global banking system is preparing for a crisis, and they're preparing to survive it by sacrificing you. Now, here's where it gets even more disturbing. The legal changes aren't just about crisis management, they're about redefining ownership itself. When you deposit money into a bank, you believe you still own that money. But legally, you don't. You own a claim against the bank. That claim is an unsecured liability on the bank's balance sheet. And in a resolution scenario, which is the technical term for when a bank is failing and regulators step in. Unsecured liabilities are the first to be converted, not the secured creditors, not the bondholders who have legal protections. You, the everyday depositor who thought a checking account was the safest place to keep money. That assumption is about to be weaponized against you. And what makes this even more insidious is that the banking system has spent decades training you to think this way. They've made banking so convenient, so seamless, so integrated into every aspect of modern life, that the idea of not using a bank seems absurd. Direct deposit, auto pay, digital wallets, credit scores. All of it requires you to keep your money in the system. And once it's in, it's no longer yours in the way you think it is. It's theirs. And in 2026, when the full weight of these new regulations comes down, that distinction is going to matter more than ever before. Now that you understand the legal framework, let's talk about why this is happening now. Because timing is everything. And 2026 isn't arbitrary. It's the convergence point of multiple systemic failures that have been building for years, some for decades. And when they collide, the result won't be a recession. It won't even be a depression. It'll be a restructuring, a reset, and your deposits are the collateral. Let's start with the obvious: debt, sovereign debt, corporate debt, household debt. The entire global economy is built on a foundation of borrowed money that can never be repaid. As of right now, global debt stands at over $300 trillion. That's more than 3 times global GDP. Think about that. The world owes 3 times more than it produces in a year. And it's growing. Every single day, that number gets bigger. Governments are spending more than they collect. Central banks are printing money to cover the gap. Corporations are borrowing to buy back their own stock. Households are leveraging themselves into homes, cars, and lifestyles they can't afford. And all of it is held together by one thing: confidence. The belief that tomorrow will look like today, that debts will be rolled over, refinanced, restructured, that growth will continue, that inflation will stay manageable, that interest rates will remain low. But all of those assumptions are breaking. Inflation is back, and it's not transitory. Central banks spent years insisting it was temporary, a byproduct of pandemic supply chain disruptions. But here we are, years later, and prices are still climbing. Food, energy, housing. Everything that matters is getting more expensive, and wages aren't keeping up. That's not a glitch. That's a feature. Because inflation serves a purpose for heavily indebted governments. It erodes the real value of debt. If you owe $100 and inflation cuts the purchasing power of money in half, you effectively only owe $50 in real terms. Governments understand this. They've been using inflation as a stealth tax for centuries. But there's a limit. Push inflation too high, and people lose faith in the currency entirely. We've seen it before: Weimar Germany, Zimbabwe, Venezuela, Argentina. When money becomes worthless, society collapses. So central banks are stuck. They can't let inflation run wild, but they also can't stop it without crashing the economy. Because stopping inflation requires raising interest rates. And when rates go up, debt becomes more expensive to service. Governments that are already spending more than they collect suddenly face exploding interest payments. Corporations that borrowed cheap money to fund operations suddenly can't afford their debt loads. Households with variable rate mortgages see their monthly payments double or triple. The whole system seizes up. And that's exactly what's starting to happen. The Federal Reserve, the European Central Bank, the Bank of England, they've all been forced to raise rates faster than at any point in decades, and the cracks are already showing. In 2023, we saw the second largest bank failure in U.S. history with Silicon Valley Bank, then Signature Bank, then First Republic, all within weeks. The official story was that these were isolated incidents, poorly managed regional banks with concentrated risk profiles. But that's not the whole truth. The real problem was duration risk. These banks had loaded up on long-term government bonds when interest rates were near zero. Those bonds paid maybe 1% or 2% annually. Then the Fed started raising rates. Suddenly, new bonds were paying 4%, 5%, even higher. The old bonds these banks were holding became worth less, a lot less. If you're holding a bond that pays 1% and new bonds pay 5%, nobody wants yours unless you sell it at a massive discount. On paper, these losses didn't matter as long as the banks held the bonds to maturity. But then depositors got nervous. They started withdrawing money. And when a bank needs cash fast, it has to sell assets. Those bonds had to be sold at a loss, and once the losses were realized, the bank's capital was wiped out, insolvent. Overnight, the FDIC stepped in, seized the banks, and made depositors whole. But here's what nobody's talking about. The FDIC didn't have enough money to do that on its own. It had to invoke a systemic risk exception to bypass the normal insurance limits and protect all depositors, even those with more than $250 billion. That exception requires approval from the Treasury Secretary, the President, and 2/3 of the FDIC board. It's not supposed to be used casually. It's supposed to be reserved for zhenzhengde existential threats to the financial system. And they used it. For 3 banks, in 1 month. That tells you how fragile things really are. But it gets worse because the method they used to resolve those banks wasn't a traditional liquidation. They didn't shut them down, sell off the assets, and distribute whatever was left to creditors. Instead, they orchestrated quick sales to larger banks. Silicon Valley Bank's assets were sold to First Citizens Bank. First Republic was sold to JP Morgan Chase. The deposits were transferred, the loans were transferred, and the acquiring banks got sweetheart deals from the FDIC, including agreements to share losses on bad loans. In other words, the government subsidized the acquisition to make sure it happened fast and quietly. Why? Because if those banks had actually failed in the traditional sense, it would have triggered a panic. Depositors at other regional banks would have started pulling their money, the contagion would have spread, and the FDIC's insurance fund, which had around $128 billion at the time, would have been drained in days. So they papered over it. They used the systemic risk exception, brokered emergency sales, and told the public everything was fine. But everything is not fine, because the same dynamics that killed those 3 banks are still in play. Interest rates are still high. Banks are still sitting on hundreds of billions in unrealized losses on their bond portfolios, and depositors are still nervous. The only reason we haven't seen more failures is because the Fed opened an emergency lending facility called the Bank Term Funding Program. It allows banks to borrow against their bond holdings at par value, meaning the Fed pretends those underwater bonds are worth their full original value and lends accordingly. It's a lifeline, a temporary patch, but it's not a solution, because eventually, those loans have to be repaid. And if the bonds are still underwater when that happens, the banks are right back where they started. Now layer on top of that the commercial real estate crisis. Office buildings, shopping malls, hotels, all of them are in trouble. Remote work has gutted demand for office space. E-commerce has killed retail. Travel patterns have changed. And the loans that funded all that construction? They're going bad, fast. Commercial real estate loans are typically structured with a balloon payment at the end. You make interest-only payments for 5 or 7 years, and then the entire principal is due. The assumption is that you'll refinance when the balloon comes due. But refinancing requires the property to be worth more than the loan. And right now, commercial real estate values are plummeting. A building that was worth $100 million 2 years ago might only be worth $60 million today. If you owe $80 million on it, you can't refinance. You default. And who holds those loans? Banks. Regional banks specifically. They're heavily exposed to commercial real estate because that's the market they specialized in, while the big banks moved into more exotic instruments. When those loans start defaulting, and they are, the banks take losses. And when the losses are big enough, they threaten the bank's solvency. Again, we're seeing the same pattern play out. But this time, the Fed might not step in, because the political environment has changed. There's no appetite for more bailouts. The public is angry. They saw what happened in 2008. They saw banks get trillions while ordinary people lost their homes. They were told it would never happen again. But here we are, 15 years later, and it's happening again. Except this time, the banks aren't getting bailouts. They're getting bail-ins. And that's the critical shift. That's what 2026 represents. It's the year the system fully transitions from too big to fail to too big to save. The infrastructure is already in place. The laws have been written. The regulatory frameworks have been tested in smaller markets like Cyprus and Italy. And now, they're ready to deploy it at scale. When the next crisis hits, and it will hit, the response won't be government intervention. It'll be depositor conversion. Your money will be used to recapitalize the banks. And it'll happen fast. Over a weekend, probably. Friday, the bank is operating normally. Monday, your deposits are equity. And by the time you understand what happened, it's too late to do anything about it. The legal justification will be airtight. They'll point to the systemic risk. They'll cite the laws that authorize bail-ins. They'll say they had no choice. And technically, they'll be right. Because the system was designed this way. Intentionally. After 2008, policymakers decided that banks needed to be able to fail without taking down the entire economy. That sounds reasonable. It sounds responsible. But the way they engineered that capability was by making you the depositor, the shock absorber. You're the buffer. You're the capital reserve that gets tapped when things go wrong. And the reason this is all coming to a head in 2026 is because that's when the last phase of Basel III takes full effect. Basel III is a set of international banking regulations designed to make banks safer by requiring them to hold more capital. Again, sounds good. But the definition of capital is where things get tricky. Under Basel III, capital includes not just cash and equity, but also certain types of debt that can be converted to equity in a crisis. Those are called bail-inable securities. Guess what counts as bail-inable? Your deposits, specifically deposits above the insured limit. But even insured deposits aren't fully safe, as we discussed earlier, because the insurance fund can't cover a systemic collapse. So in practice, everything is at risk. The entire structure of modern banking has been redesigned around this principle, and 2026 is when it becomes operational. That's not speculation. That's the timeline that's been published by the Basel Committee on Banking Supervision, endorsed by the Financial Stability Board, and implemented by national regulators around the world. It's happening, and almost nobody knows. Here's what makes this entire situation even more dangerous. Most people still think their biggest financial threat is a stock market crash or losing their job. Those are real risks, but they're not systemic. They're personal. You can recover from a job loss. You can rebuild after a market downturn. But what's coming in 2026 isn't something you recover from with hard work and discipline. It's a structural shift in how wealth itself is defined and controlled. And once your deposits are converted into equity in a failing bank, there's no coming back from that. Your savings don't just decrease in value. They vanish into a legal black hole where your rights as a depositor are subordinated to the survival of the institution. Let me be very clear about what subordination means in this context. In bankruptcy law, there's a hierarchy. Secured creditors get paid first, then unsecured creditors, then shareholders. Depositors used to sit somewhere near the top of that hierarchy because deposits were considered sacrosanct. But the new resolution frameworks have reclassified depositors as unsecured creditors, and in some cases even lower. When a bail-in happens, your deposit claim is converted to equity, which puts you at the absolute bottom. You become a shareholder in a bank that's insolvent. And here's the cruel mathematics of it. Let's say the bank is worth $50 billion in assets but has $80 billion in liabilities. It's $30 billion underwater. To make the bank solvent again, regulators convert $30 billion of deposits into equity. Your $100,000 becomes shares in a bank that's technically bankrupt. Those shares might be worth $20,000 on day one, or $10,000, or nothing, depending on how the market values a bank that just admitted it's insolvent. And you can't sell them right away because there's usually a lockup period. By the time you're allowed to sell, the price has collapsed further. You're lucky if you get 10 cents on the dollar. That's not a hypothetical. That's what happened in Cyprus. Depositors who had $200, $1,000 in the bank ended up with maybe $30,000 in recoverable value after the forced conversion and subsequent market collapse of the bank's stock. The rest? Gone. Not stolen, not taxed, legally restructured, and there was no recourse. No lawsuit you could file. No regulator you could complain to, because it was all done according to the law that's now in place in virtually every major economy. Now, you might be thinking, okay, but I don't have more than $250,000 in any one bank, so I'm insured. I'm safe. And on paper, you're right. The FDIC insures up to that amount. But let me tell you what they don't advertise. First, that insurance is only as good as the fund backing it. And as we've already established, the fund is a fraction of total insured deposits. In a systemic crisis involving multiple large banks, the fund gets wiped out almost immediately. At that point, the FDIC has three options. One, they can borrow from the Treasury, which means taxpayer money, which means political backlash and delays. Two, they can impose a special assessment on surviving banks, which weakens those banks and spreads the contagion. Or three, they can pay you in promissory notes or equity instead of cash. Guess which one is fastest and least politically complicated? The third one. You get a piece of paper saying the government owes you money. Maybe you'll get paid in full eventually. Maybe you'll get 50 cents on the dollar. Maybe it takes years. And in the meantime, you have no access to your money. Your rent is due. Your mortgage is due. Your bills are due. But your money is locked in a bureaucratic process that could take months or years to resolve. That's the reality of deposit insurance in a systemic crisis. It's not a guarantee. It's a promise. And promises break under pressure. Second, even if the FDIC does pay you in full, there's the issue of timing. In a normal bank failure, the FDIC takes over on a Friday night and has your money available by Monday morning. They're very good at that. But in a systemic crisis involving dozens or hundreds of banks simultaneously, that process breaks down. There aren't enough FDIC staff to manage that many resolutions at once. There aren't enough healthy banks willing to acquire the failing ones. The whole system gets bottlenecked, and while you're waiting, your money is frozen. You can't access it. You can't spend it. You're effectively broke even though theoretically you're insured. And here's the psychological trap. Because you think you're insured, you don't prepare. You don't diversify. You don't take precautions. You leave all your money in one or two banks because it's convenient, and you trust the system. And that trust is exactly what makes you vulnerable. Because when the crisis hits, everyone realizes the same thing at the same time. And they all try to withdraw their money at once. That's called a bank run. And bank runs are self-fulfilling prophecies. Even a healthy bank can't survive a run because of fractional reserve banking. The bank only keeps a small percentage of deposits in cash. The rest is loaned out. So when everyone shows up demanding their money back, the bank doesn't have it. They have to sell assets, call in loans, borrow from other banks, or borrow from the Fed. And if the crisis is widespread, none of those options work. Other banks won't lend because they're hoarding cash themselves. The Fed can provide liquidity, but that takes time and comes with strings attached. And selling assets in a panic market means selling at a loss, which destroys the bank's capital, which makes the problem worse. It's a death spiral, and the only way to stop it is to halt withdrawals. Which brings us to something most people have never even considered: capital controls. In a severe crisis, governments can and will restrict your ability to access your own money. They can limit ATM withdrawals to $100 or $200 per day. They can freeze wire transfers. They can prohibit cashier's checks over certain amounts. They can even freeze accounts entirely for systemic stability. This isn't theoretical. It's happened repeatedly. Greece did it in 2015 during their debt crisis. Cyprus did it in 2013. Argentina has done it multiple times. India did it in 2016 when they demonetized large currency notes overnight. China has permanent capital controls that restrict how much money citizens can move out of the country, and in every case, the government justifies it as temporary and necessary. They say it's to prevent panic, to stabilize the system, to protect the currency. And technically they're right. Capital controls do prevent bank runs. But they also trap your wealth. You can see your account balance on your app, but you can't access it. It's Schrödinger's money. It exists and it doesn't exist at the same time, and the longer the controls stay in place, the more value your money loses to inflation. Because while your money is frozen, the government is printing more to cover its obligations, which devalues the currency, which means even if you eventually get access to your funds, they're worth less than before. You didn't lose money in nominal terms, but you lost purchasing power, which is the same thing. Now here's where it gets truly insidious. The banking rewrite in 2026 isn't just about giving banks the legal authority to bail in depositors. It's about creating a framework where that process happens automatically, without political debate, without media coverage, without public awareness until it's already done. The way it's structured, once a bank hits certain capital thresholds, resolution mechanisms trigger immediately. Regulators step in over a weekend. Depositors wake up Monday morning to a fait accompli. There's no warning, no chance to withdraw your money beforehand. Because if there were warning, everyone would withdraw, which would cause the very collapse the system is trying to prevent. So the whole thing is designed to happen in secret, in speed, with legal finality. And by the time you understand what happened, your money is already converted. You're already a shareholder in a dying bank. You're already at the bottom of the capital structure, and there's nothing you can do about it. No protest, no lawsuit, no political pressure campaign. It's done. Legal. Irreversible. That's the nightmare scenario. And it's not a distant possibility. It's the explicit design of the post-2008 financial architecture. Policymakers looked at the chaos of the financial crisis and decided the problem wasn't the bank's reckless behavior. The problem was that there was no orderly way to let them fail. So they built one. And the cost of that orderly process is you. Your deposits, your savings, your financial security. You're the designated loser in this system. And the timing, 2026, is when all the pieces click into place. The Basel III capital requirements, the resolution authority frameworks, the bail-in legal structures, the stress testing regimes that identify which banks are most at risk, the living wills that banks have filed showing exactly how they'd be dismantled in a crisis. All of it is ready, all of it is waiting, and all it takes is a trigger. That trigger could be a lot of things. Another wave of regional bank failures, a commercial real estate collapse, a sovereign debt crisis in Europe, a derivatives blow-up, a geopolitical shock that freezes credit markets. Any of these could set off the chain reaction, and once it starts, it moves fast, because modern banking operates at the speed of electronic transfers. Money moves around the world in milliseconds, and so does panic. When depositors in one country see bail-ins happening, they immediately try to pull their money from banks in other countries. The contagion spreads globally within hours, and because the legal infrastructure for bail-ins is already in place in most major economies, the same solution gets applied everywhere simultaneously. It's coordinated, it's international, and it's unstoppable. You can't outrun it by moving your money to another country because that country has the same laws. You can't hide it in a different bank because all banks are subject to the same regulations. Your only option is to get your money out of the banking system entirely, but even that has risks and limitations, which is what we need to talk about next. Because understanding the problem is only half the battle. The other half is knowing what to do about it. And that's not as simple as it sounds.